There is a trade happening right now in the market that a lot of investors are either completely missing or dismissing for the wrong reasons. And the people who got in early are sitting on some of the most extraordinary short-term gains we have seen from a single ETF in recent memory. We are talking about DRAM, the Roundhill Memory ETF. An ETF that tracks the companies building the single most critical bottleneck in the entire artificial intelligence revolution. Not the chips that do the computing. Not the software that runs the models. The memory. The high-bandwidth memory without which none of the AI infrastructure that every major technology company on Earth is racing to build can actually function. And right now, that memory is sold out. Not for weeks. Not for months. Sold out through 2026. Possibly into 2027. And the CEOs of the most powerful technology companies in the world, Apple, Amazon, Microsoft, Google, Nvidia, are lining up and saying publicly, on earnings calls, in front of shareholders and analysts, that they do not have enough of it. That memory is their single biggest constraint. That they would do almost anything to secure more. When Tim Cook says he cannot make enough iPhones without more memory chips. When Jensen Huang says the minute memory is available he is buying every unit. When hyperscaler after hyperscaler reports enormous AI demand but flags memory supply as the limiting factor, that is not noise. That is signal. And DRAM is one of the clearest, most direct ways to get exposure to that signal as a publicly traded investor. Today on Dividend Desk, we are doing the complete bull case breakdown on DRAM. We are going through the memory thesis from first principles, explaining exactly what high-bandwidth memory is and why it is different from the retail RAM market that most people are watching, looking at the three companies that dominate this space and why DRAM gives you access to the ones you cannot easily buy on your own, examining the fundamentals behind the revenue and earnings growth that is driving this trade, and being honest about the risks and what investors need to understand before putting capital here. Let's get into it. Before we dive in, if you are not yet subscribed to Dividend Desk, hit that subscribe button right now. We cover investing, ETFs, market analysis, and portfolio strategy every single week. Hit like if this video adds value. Now let's go. Disclaimer: nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely for educational and informational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. DRAM is the Roundhill Memory ETF, a thematic ETF built specifically around the companies that manufacture memory semiconductors. At its core, approximately 75% of the fund is concentrated in three companies: Micron Technology, SK Hynix, and Samsung. Those three names represent essentially the entire global supply of high-bandwidth memory chips. There are no meaningful alternatives. There are no other companies producing HBM at commercial scale. If you want exposure to the memory chip supply chain, specifically the kind of memory that powers artificial intelligence infrastructure, you are dealing with a three-company oligopoly, and DRAM gives you direct, concentrated exposure to all three in a single publicly traded vehicle. The reason that matters is straightforward. Micron is a US-listed company that most American and international investors can access without difficulty. But SK Hynix, which is a South Korean company and arguably the most advanced HBM manufacturer in the world right now, and Samsung, also South Korean, are not easy for most retail investors outside of Korea to buy directly. The process of purchasing foreign-listed securities, dealing with currency conversion, navigating foreign brokerage requirements, and understanding the tax implications creates enough friction that most individual investors simply do not do it. Before DRAM launched, investors who wanted exposure to SK Hynix and Samsung without the complexity of buying Korean-listed stocks had limited options. One alternative was EWI, a Korean market ETF, which does provide exposure to those companies but comes with the trade-off of also holding a broad basket of other Korean stocks that have nothing to do with memory chips. If you are bullish on memory specifically, owning a Korean market ETF that gives you 50% memory exposure and 50% exposure to Korean banks, consumer companies, and industrials is an imprecise and diluted expression of that thesis. DRAM solves that problem cleanly. It is a pure-play vehicle. When you buy DRAM, you are buying the memory thesis directly, not a country, not a broader semiconductor index, not a diversified tech basket where memory is a small slice of a much larger exposure. But there is a specific and important reason why this cycle has a different character than previous ones, and it centers on the distinction between two completely different memory markets that are being conflated in a lot of the skeptical commentary. The first market is consumer and retail memory, the RAM you buy for your desktop computer, the DRAM in your laptop, the storage in your phone. This market does follow traditional cyclical dynamics. Consumer demand fluctuates with the economy. Supply adjusts over time. Prices go up and down. And in recent periods, retail memory prices have indeed fallen. If you follow memory prices in the consumer space, you have seen softness, and that softness has fed the narrative that memory is in a down cycle. The second market is high-bandwidth memory HBM, the specialized, high-performance memory chips required for AI computing. HBM is architecturally different from standard DRAM. It is stacked in three-dimensional layers, bonded directly to the AI accelerator chips it serves, and optimized for the kind of massive, parallel data throughput that machine learning workloads demand. An H100 GPU from NVIDIA, for example, requires HBM to function. A data center running large language models requires HBM. Every AI inference chip, every training cluster, every hyperscaler AI infrastructure build requires HBM, and the amount of HBM required per unit of compute is increasing as AI models grow larger and more complex. And here is the critical fact that is being missed by everyone looking at retail memory prices and concluding that memory is in a down cycle: HBM is sold out. Not experiencing softness. Not in modest oversupply. Sold out through the end of 2026 and potentially into 2027. The manufacturers Micron, SK Hynix, and Samsung are not choosing between selling to consumers and selling to hyperscalers. They are actively redirecting their capacity away from consumer memory and toward HBM production, because HBM commands dramatically higher margins and has essentially unlimited demand from the most well-capitalized buyers in the world. Micron's management has been explicit about this strategic shift. The company is deliberately deprioritizing retail memory production to focus its manufacturing capacity on high-bandwidth memory for the data center and AI market. This is not a surprise market development that management is scrambling to respond to. It is a deliberate strategic choice driven by the recognition that HBM demand is structural, durable, and enormously profitable compared to the consumer memory business. The evidence from earnings calls is equally compelling and genuinely unusual in its consistency. Quarter after quarter, the CEOs of Apple, Amazon, Microsoft, and Google have all said essentially the same thing: AI demand is real, return on investment on AI is materializing, and the binding constraint is memory. Not compute. Not software. Not data. Memory. When the four largest technology companies in the world are all pointing to the same specific bottleneck on their earnings calls, that is not a coincidence. That is a real supply constraint at an industry-wide level. One of the most striking recent developments in the memory supply chain is not just that hyperscalers are buying every unit of HBM they can get. It is that they are actively funding the expansion of production capacity at the manufacturers to accelerate supply. SK Hynix faces a specific capital constraint that limits how quickly it can scale its HBM production. The lithography machines required to manufacture advanced memory chips, machines produced by ASML, the Dutch semiconductor equipment company, cost approximately $20 billion each. Not 20 million. 20 billion. For a company like SK Hynix, acquiring those machines at the pace required to meet current HBM demand is a genuine capital challenge. So what are the hyperscalers doing? They are offering to fund the acquisition of those machines directly. They are going to SK Hynix and Samsung and effectively saying, "We will provide capital, we will commit to multi-year purchase agreements, we will do whatever is necessary to accelerate your production capacity because we need more HBM and we need it faster than you can build it at your current pace." When Apple, Google, and Amazon are writing checks to help memory chip manufacturers buy production equipment, the demand signal is beyond anything that conventional cyclical analysis captures. These are not companies trying to secure favorable pricing on a commodity they could buy elsewhere. There is no elsewhere. SK Hynix is the world leader in HBM technology. Samsung and Micron are the only other producers. And all three are running at capacity with committed order books extending well into the future. The revenue and earnings numbers at the major memory companies are reflecting this reality in real time. SanDisk, formerly the flash memory division of Western Digital, has delivered revenue growth of approximately 100% quarter-over-quarter in recent periods. At the same time, operating expenses grew at a fraction of that rate. The result is an expansion in profit margins that has driven earnings growth at a pace that mirrors the revenue growth. When you have a company growing revenue 100% quarter over quarter while converting the vast majority of that new revenue into profit, the earnings growth story is extraordinary. And the valuation math that flows from that growth rate is equally compelling. A company with a P/E ratio that looks elevated in absolute terms but is actually unchanged year over year because earnings have grown at the same rate as the stock price. Given the strength of the memory thesis, the obvious question is, why own DRAM the ETF rather than simply buying Micron directly? It is a fair question and deserves a direct answer. The first reason is the SK Hynix and Samsung exposure. As we discussed earlier, these are Korean-listed companies that most investors outside of Korea cannot easily purchase directly. SK Hynix in particular is arguably the most important company in the HBM story right now, the company that produces the HBM used in NVIDIA's most advanced AI chips. Getting direct, clean exposure to SK Hynix in a standard brokerage account is not straightforward for most investors. DRAM provides that exposure without friction. The second reason is that DRAM is a purer expression of the memory thesis than any of the major broad semiconductor ETFs. SMH, the VanEck Semiconductor ETF, is probably the most popular semiconductor ETF, and it does hold Micron. But Micron represents only a modest percentage weight in SMH, which is also holding TSMC, NVIDIA, Broadcom, AMD, ASML, and dozens of other semiconductor companies across multiple subsectors. If you are specifically bullish on memory and HBM, SMH gives you a diluted, noisy version of that thesis mixed with exposure to logic chips, foundries, equipment makers, and the rest of the semiconductor landscape. Similarly, the Nasdaq 100 gives you exposure to Micron at approximately 1 to 2% of the index. The S&P 500 gives you even less. If the memory trade plays out the way the bulls expect, having 1 to 2% of your portfolio indirectly exposed to it through a broad index is not going to meaningfully move the needle on your returns. DRAM, with 75% of its portfolio in the three core memory companies, is the concentrated expression of the thesis. The third reason is timing and market structure. Memory stocks experienced a significant correction earlier in 2026 during the period of geopolitical uncertainty and broader market risk-off sentiment. That correction created an entry point at prices that looked very different from where the fundamental thesis on HBM supply and demand stood. Investors who recognized the disconnect between the short-term price action driven by macro fear and geopolitical uncertainty and the unchanged underlying fundamentals of HBM demand found what appears to have been an exceptional entry point. The subsequent recovery in memory stocks has validated that the correction was market-driven noise rather than a signal that the memory thesis had changed. No honest discussion of a high-momentum thematic trade like DRAM is complete without addressing the question of valuation and exit strategy. Because one of the most common mistakes investors make in high-conviction thematic trades is getting the thesis right but getting the exit wrong. The bullish case on price targets for DRAM ranges from $100 per share as a near-term target through end of year, to $150 per share within the next 12 to 18 months, with longer-term targets depending significantly on how the underlying earnings trajectories of Micron, SK Hynix, and Samsung develop. Whether those targets are achievable depends on the continuation of HBM demand growth, the pace of production capacity expansion at the manufacturers, and the absence of a major negative catalyst, a supply glut, a geopolitical disruption to semiconductor trade, or a meaningful slowdown in AI infrastructure investment. The right framework for thinking about when to sell is not a fixed price target in isolation. It is a fundamentals-based framework that monitors the actual earnings and guidance data from the underlying companies at each quarterly earnings cycle. As long as Micron, SK Hynix, and Samsung are reporting strong HBM demand, sold-out order books, improving margins, and positive forward guidance, the thesis remains intact and the position remains justified. The moment the fundamentals change, the moment management guidance starts signaling demand softening, order books shortening, or margin compression from oversupply, that is when the thesis requires reassessment. The specific metric to watch is HBM pricing and allocation. As long as HBM is sold out and hyperscalers are paying premium prices and committing to multi-year agreements, the revenue and earnings trajectory for the memory manufacturers remains strongly positive. If there is evidence that HBM supply is beginning to catch up with demand, that spot prices are softening, that order books are shortening, that allocation commitments from hyperscalers are declining, that is the early warning signal that the supply-demand dynamic which underpins the entire thesis is beginning to shift. A 10 to 15% pullback from current levels, if driven by macro factors rather than fundamental changes in the memory supply chain, would represent a reasonable opportunity to add exposure rather than a reason to exit. The underlying thesis has not changed if Tim Cook is still saying he cannot make enough iPhones without memory chips, if Jensen Huang is still saying he buys every unit of HBM the moment it becomes available, and if SK Hynix is still reporting sold-out order books. Short-term price volatility in a high-beta thematic ETF is not the same thing as a change in the fundamental investment thesis. No bull case is complete without an honest accounting of the risks. And DRAM, for all its appeal as a concentrated expression of the memory thesis, carries specific risks that investors need to understand before sizing a position. The concentration risk is the most obvious. DRAM is 75% exposed to 3 companies. If any one of those companies, Micron in particular, as the most liquid and US-listed of the 3, experiences a significant earnings miss, a guidance reduction, or a material negative development in its HBM business, the ETF will feel that impact acutely. Concentration amplifies both returns and drawdowns. The geopolitical risk is also meaningful and specific to this trade. 2 of the 3 core holdings, SK Hynix and Samsung, are South Korean companies operating in a geopolitically sensitive region. Trade policy changes, tariff escalations, or regional security developments can all affect these companies' ability to operate, export, and generate revenue. The US-China technology trade tensions are also relevant, as China represents a meaningful portion of the customer base for certain memory products, and restrictions on memory chip exports to China have been an ongoing policy consideration. The cyclical risk, while differentiated from previous memory cycles as we discussed, cannot be dismissed entirely. The HBM demand story is real and is being validated by hyperscaler earnings data. But it is also possible that AI infrastructure investment growth moderates, that the pace of HBM demand growth slows, or that production capacity expands faster than anticipated and begins to catch up with demand sooner than the current sold-out order books would suggest. Any of those developments would change the supply-demand math and could trigger a significant correction in memory stocks. And finally, the momentum risk. DRAM has delivered extraordinary returns in a short period of time. Some portion of the recent performance reflects genuine fundamental re-rating as the market prices in the HBM demand story. But some portion also reflects momentum, investors piling into a winning trade because it is winning, without deep fundamental analysis of what they are buying. When momentum-driven investors exit, the selling can be sharp and rapid. Investors entering DRAM today need to be prepared for that volatility and have a clear thesis-based framework for evaluating whether any pullback represents an opportunity or a warning signal. The memory trade is real. The HBM demand story is validated by the earnings calls of the most powerful technology companies in the world. The supply constraint is structural and extends well into 2026 and potentially beyond. And DRAM provides one of the clearest, most direct expressions of that thesis available to retail investors, giving concentrated exposure to the 3 companies that control global HBM supply, including SK Hynix and Samsung, that most investors cannot easily access directly. The bull case is compelling. The fundamental backdrop is strong. The earnings growth at the underlying companies has been extraordinary. And the price action that has already occurred, while impressive, does not necessarily mean the opportunity has passed, particularly for investors who monitor the quarterly earnings data and maintain a thesis-based rather than price-based approach to managing their position. But this is a concentrated, high-beta, thematic trade. It is not a diversified core holding. It carries specific concentration risk, geopolitical risk, and the inherent volatility of a fund whose performance is tightly linked to the fortunes of 3 companies in one specific subsector of the semiconductor industry. Size accordingly, understand what you own, watch the fundamentals closely, and never let a strong recent return substitute for an honest assessment of where the underlying thesis stands today. At Dividend Desk, this is the kind of market analysis we bring you every week, whether it is income investing, ETF strategy, or emerging themes like the memory trade that deserve serious, honest examination. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community. The link is in the description, where we track developments like this in real time. This is Dividend Desk. We will see you in the next one.